Well, I look for two particular types of companies primarily to invest in my fund. One is quality companies, which have very strong franchises and that we think are being undervalued by the market right now in terms of their strength. And the other is at the opposite end of the spectrum really, which is self-help or recovery type companies where they've had some problems but where we've had some changes and we think they're going to get better going forwards. Those are the two primary areas that we focus on, and I utilise a team of 15 of us on our UK desk at Old Mutual doing this individual stock work every day, trying to identify these sorts of opportunities to put in the portfolio. Well, we have a number of big positions in the portfolio at the moment. Two I'm particularly keen on at the moment would be telecoms group Vodafone and food retailer Tesco. Tesco is interesting because it's a turnaround situation where we've got new management in, companies now run by a chap called Dave Lewis, and he's about 18 months into a programme of rehabilitating Tesco and making its UK business in particular much more profitable again. We're very supportive of the actions he's been taking. Early days, but so far results are looking pretty promising. In the case of Vodafone, a big mobile telecoms company as we all know, they've got lots of operations across many different countries, but particularly in continental Europe. And slowly over the last few years, those industries across Europe have been getting a little bit better for them. So the pricing power of the industry has been getting better, consolidation has been happening in the industry, and it's meant that Vodafone's position has got stronger and their ability to make more profit has got better as well. So we're very keen on both of those companies right now. I've recently started holding in a company called Phoenix Group, which is a life insurance company. And what they do is they run closed life insurance businesses. So there's ones that don't sell policies anymore to new customers, but they run off old policies. And that industry is really undergoing some consolidation right now, and Phoenix is incredibly well placed to buy small closed life insurance businesses and consolidate them into its own business and take out costs and synergies and so forth. They did two transactions last year, which is just the start in our view of the consolidation that this industry is going to undergo, and as I say, I think they're ideally placed to benefit from that. I think it has, not just recently, but the fact that we are now 8 years into a very strong stock market upswing, and it's meant that valuations across the market have got quite high, I think, and so it is hard to find value. There are pockets. I think big oil companies still look good value. I think pharmaceutical companies still look good value, and I think companies like Tesco still look good value. But it is, as a general rule, getting a lot harder to find value, given how high stock markets are right now. Quite cautious about the outlook for the market, so I'm not expecting great returns in the near term overall, and so I'm looking for companies that primarily can do things to improve their own fortunes without relying on economic growth. And examples like a Phoenix Group or a Tesco or a Vodafone, where I can see those companies making, if everything goes to plan, 10, 15, 20% type returns over the next year or two for my investors. And I think in a more constrained stock market environment, I think those will prove to be pretty good returns.